Coming up on today's show, Tom Lee's take on the market and what he believes will happen next, why these stocks fell when the market rallied, what to expect from the Santa Claus rally, and will the government shut down? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks bounced back on Friday as investors digested key inflation data that showed a deceleration in price increases during the month of November. Now, if you go to yesterday's video, around the 6-minute mark or somewhere between the 6 and 8 minute mark, I talk about what cool PCE print could mean for the market, and I pretty much say that a cool PCE print means stocks are going to rally. That's exactly what we saw here today. It was green across the board, and pretty much cooler prices, cooler inflation means a whole bunch of stuff for rate cuts. It's generally more on the dovish side, and so what we saw on Wednesday was a Fed pivot, but given this PCE print and maybe the inflation print we might see in December, as well as the upcoming CPI print in just a couple of weeks, that could be all turned on its head. And this pivot we saw from the Fed on Wednesday, that could be all but done. However, there were some red spots that did hold the market back. We saw stuff like Nike. They reported their earnings down 0.27%. Tesla was down 3%, Walmart was down 1.46%, Meta down 1.47%. But that was really it in terms of big names, bar Microsoft, which was pretty much flat in today's trade, but green across the board, small, medium, and large caps. And in fact, we actually saw a propensity here for the mid-cap sector. They really did outperform, with value core and growth all returning in excess of 1.5%. But we saw a small value rally. We saw a large growth rally. It was just a broad-based rally on the back of cooler than expected inflation that beat economists' expectations. And guys, we saw it today. Green across the board. Every sector was green. However, the discretionary space on the back of that Tesla decline was only up 0.26%. But to actually see Tesla fall 3% and the sector as a whole to gain really goes to show the overall strength we saw in the broad market. We also saw Staples gain, XLC gain, and they were the only three sectors that underperformed the SPY. So it was a huge broad-based rally. In fact, excluding these three, XLC, XLP, XLY, right? And then the S&P 500, every sector gained in excess of 1%, from energy to real estate to financials, and it had to do with the pricing dynamics from yields, the dollar, inflation, what that means for the terminal rate, and all of these together meant stocks went on a big rally. But when you look at the big picture, the last 5 days of trade, every sector was red. So yes, we did see a big bounce back here on Friday, but after the FOMC here on Wednesday, we did actually see a decline and we never recovered those losses, with the S&P 500 falling 2.18%, a very ugly week. The RTY falling 4.5% for the week. The worst performing sector being energy and real estate. The best performing sector, relatively speaking, being the tech sector, up 1.24%, and everything in between. All in all, it was a really ugly week. No matter where you were in your portfolio, you probably saw declines, small, medium, large. It was just an ugly week, all things considered. But a great day on Friday, where we likely see follow through as we actually officially enter the Santa Claus rally from next week, which is the last 5 trading days of the year and the first 2 trading days of the new year. However, despite all of the green we got today, it wasn't all good news. NVO, Novo Nordisk, was actually down 17%. The pharmaceutical company plunged the most in over 2 decades after its obesity drug trial disappointed investors. Novo had been predicting that its trial drug would lead patients to lose 25% of their body weight, but the trial results fell short, only meeting a 20% mark. And this means that Novo likely won't be able to compete with some of the other weight loss drugs in the market. That's why the stock was down 17%. Great dip buying opportunity because there's so much demand for these weight loss drugs and they're just getting better and more efficient. And even a 20% efficacy rate in weight loss in your first year, very, very good results. And I do think this will just be a dip buying opportunity because there's, again, so much demand and just this tailwind for these weight loss drugs. Tesla today was down nearly 4%. And at one point, it was down much more here in the pre-market. And that's because Tesla recalled about 700,000 vehicles over a tire pressure monitoring system defect. That's the TPMS defect. So all these vehicles need to be recalled and fixed up. That's why we saw the stock pull back from its highs right here. We'll see how this affects sentiment, but I still think $500 is on the cards in the first quarter of 2025. Nike, the shoe and athletic apparel company, fell as much as 4% here on Friday, however, recovered most of its gains, and that's because its second quarter earnings actually beat expectations, but offered an outlook for the current quarter that sent investors fleeing. Now, when the results released, the market actually really did like the results. Nike at one point pre-market was up 11%, right? It's just once the earnings call came out and management started guiding for the next quarter, things started to fall apart. And that was simply because the management team predicted third quarter revenues to fall by low double digits. That exceeded analysts' expectations, and that's why the stock was only down 0.66%, but as much as 4% here in the pre-market. So we'll see where this leaves Nike. I mean, it does look like a lot of that news was already priced in. We just saw a big reaction with regards to Nike and all of the other dynamics we saw in the week. But the big thing that actually moved the market today, what caused stocks to be so green, was actually PCE. You can see that the core PCE month over month, the actual figure was 0.1, the consensus was 0.2. We saw the same here in the month over month headline. 0.1 was the actual, 0.2 was the consensus, and this meant that the year over year price index was 2.4% versus the 2.5% consensus. So inflation did cool on a month over month basis, especially PCE. And why this is so important is because PCE is the Fed's preferred gauge of inflation. And we also saw personal income outlays, which is personal income and personal spending, fall as well, 0.3 and 0.4 versus the consensus 0.4 and 0.5. So inflation this month came cooler than expected. And a lot of this was, yes, on disposable income and employee compensation, but also on shelter. Shelter continues to decline. That's something we saw in the CPI print a couple of weeks ago. And this bodes really well for rate cuts. And again, guys, I predicted this in yesterday's video. Go watch yesterday's video. I talk about what a cool PCE print means for the market and how we could really boost stocks and why stocks would be really bullish on that regard. And so maybe the Fed wasn't looking at this. Maybe the Fed were looking at different data. Regardless, we got a reset from the Fed and we've got cooler inflation. If this can flow on into the data we get into 2025, particularly into the first quarter, a lot of the pullback and a lot of the volatility we're seeing in the market right now could represent a dip buying opportunity. And this is why I said, because this was always going to be a short-term blip, all things considered, because the economy is good, the consumer is good, inflation is still trending down, and even more so now with this PCE print. And if shelter continues on the path it is right now, we should see the Fed's 2% target occur as close as the end of 2025. And diving into the charts, we see equities very bullish today. The SPY up 1%, the Nasdaq 100 up 0.85%, small caps outperformed large. The RSP was the most bullish, up 1.4%. We also saw mid caps gained as a result, profitable small caps as well. And with the dynamics we saw with PCE, we actually saw yields fall. That supported stocks. The dollar fell as well. That supported multinational stocks, and bonds did gain as a result. So the correlation between equities and bonds continues to be positive. And then we also saw gold and silver commodities gain, both up in excess of 1%, and crude up 0.17%. And if we actually go into the S&P 500, look at the gamma chart, guys, we are still in negative gamma. However, a couple of things to note. Let's actually just zoom in. We moved right below the put support. What's really positive and why I continue to stay positive all week was because the put support in the S&P 500 didn't actually move especially lower. Normally you'd see the put support tick lower. That was simply not the case, meaning that Wall Street, with regards to the options market, they knew something was going on. They probably knew the PCE report was going to come in cool. That's why we didn't see a ton of bearish bets come into the market. However, we are still in negative gamma. We did get into positive gamma right here. but bears came in a very big way. It took us back into negative gamma. However, we are at the top range in this negative gamma environment. And look, from next week, it's going to be a light volume week. But if we could actually get above the gamma flip, based on the light volume, we could probably just trade, upwards. A lot of the volatility we saw today was also because of triple witching. So do take that with a grain of salt. Nonetheless, what we do want to see right now is a move into positive gamma. And then from there, we can just buy dip, sell rips, aim for the core resistance, aim for these all-time highs. We do have PCE on our side, and the fundamentals of the economy are very, very strong. All in all, guys, I said buy the dip right here. I bought the dip. I added exposure to most of my ETF portfolio, and we probably will go higher from here. I mean, if the economic data is solid and inflation continues on the path it is, we probably get more than 2 rate cuts in what the Fed is expecting next year. In this video, the market can't stand 7% mortgage rates right now. We need shelter inflation to come down so we get more rate cuts and get that mortgage rate below the 6% mark into the 5 handle. That will open up a big part of the economy that's going to drive growth into 2025-26. I think this is some of the data the Fed's looking at when it comes to why they actually are cutting rates in such a strong economy, because they do know that only certain parts of the economy are thriving. Others are still feeling the heat. That's why we're getting rate cuts, and this is actually a good thing. We want the housing market to come back into play, the real estate market, because that can really drive growth at least for the next 5 years, particularly in this cutting cycle. Nonetheless, let's get back to equities. And for the S&P 500, yes, we're in negative gamma, but next week, the second we get a close in positive gamma, it opens up these highs right here and we go from there. So again, this is starting to look like a garden variety pullback. We did do some consolidation here at the lows of the put support. We did the same in the Nasdaq 100, very similar. We did some consolidation right here. We went below, however, the put support didn't move. We did have triple witching, and that's why we did see all of the volatility we did today. However, we are seeing consolidation right here at this level, and all we need to do now is get back into positive gamma, and that opens up the highs for this market. For the RTY, the IWM, very, very solid. Again, we're consolidating here at this put support level. A lot of volatility because of triple witching. There's a little bit more of a move that the RTY needs to do. So what the RTY needs to do next week is actually take us as close as we can to the gamma flip zone. Once there, maybe after Christmas week, we can then look to getting above. And I think what the mega caps need to do is retake their gamma flip, have multiple closes above the gamma flip in positive gamma next week. If we can do that where the Nasdaq 100 and the S&P 500 close in positive gamma and the RTY is flirting with the gamma flip, that opens up upside into 2025, and it probably opens up a bullish January. If we continue to trade here in negative gamma all of next week, that probably doesn't bode well for January, and we probably will see some more volatility, assuming the data doesn't go our way. Nonetheless, things are looking constructive after that PCE print. I literally said it yesterday. I actually said it multiple times this week. A cool PCE print will totally change the market. Definitely eased angst in investors' minds. Now, I do still like the same stocks, the same ETFs, PayPal, Paycom, Google, Uber. I was so close in taking a position in Uber today. I'm still doing my research. I said I would take the weekend to continue to do research. But when we look at the year-to-date gains, guys, look at the RTY. Great opportunity right here. If we look at the technical chart, right, just on a technical basis, if we actually find support in the RTY right here and move up, this is a very, very strong support zone, it looks like. And support turns resistance. As you can see right here, resistance turns into support, and it meant the next leg higher. If we find support right here, we then probably move higher into all-time highs. Same with the S&P 500. Looks very, very good. We're actually holding the Trump gap up right there. And then for the Nasdaq 100, looks extremely constructive. The Nasdaq 100 looking the most constructive. In fact, this looking like a higher low, all things considered. So, the game plan next week. The S&P 500 and Nasdaq 100, we want to retake the positive gamma zone. For the RTY, we want to get as close to the gamma flip zone. If we can flirt around that area, that's great. If we can retake the positive gamma, even better. But we just want to see price action closer towards the gamma flip than we are to the put support. If we can get those dynamics next week, coupled with maybe yields falling, the dollar falling as well, that will be very, very constructive, and equities probably move higher into next week, move higher into the new year. That's what we want to see. If we continue to consolidate here at these areas, the put support probably will move lower, and that probably means more downside for equities. So a pretty big week in a light volume week next week. There's a lot to contend with, a lot to deal with, but the plan is very, very simple as to what stocks need to do for us to go higher and to start the 2025 year in strong fashion. So buy the dip. And diving into sentiment, this is the fear and greed index, and it finally happened. We are officially in the extreme fear zone. Guys, markets got fearful very, very quickly, and that tends to happen when you have turned the way it did on Wednesday. However, as longer term investors, this is simply opportunity, because when we look at the data, when we look at the last year, every time we've come near or inside the extreme fear zone, like we did here in July, like we did here in April, what has happened? We've seen a rally ensue. In both instances, a very violent rally to the upside, and in both cases we went back into the greed zone, and in the case of the July situation, we slightly went into the extreme greed zone for just a couple of days. So we don't stay in the extreme fear zone for very, very long. So start taking the opportunities. I bought some stock, I bought some ETF, QSML, QUAL, that's large cap, mid cap, and small cap quality. I also bought some of this income ETF, GIAX. It's a call credit spread ETF. It yields something like 2% per month. I bought one block yesterday. I'm going to buy a couple blocks today. By the time this video released, I probably will have about $20,000 in market value. Probably going to buy about 30,000 of this ETF. Just something new, something interesting to add to my portfolio. I consider this an alternative investment, and I think you should have anywhere from 1 to 2% in alternatives in your portfolio. So this is why I'm getting it. It's just one of these, high yield ETFs, because I'm very levered to growth at the moment. So to have a bit of income, to have $800 or $900 coming every single month that you can allocate to your portfolio is really, really good. Now, the reason why we're getting this opportunity to buy the dip was simply because Jerome Powell came out and he was slightly more hawkish than the market anticipated. And as a result, the market pulled back because we need to reprice growth, valuation, and what all of this means for growth looking into 2025. And as a result, the market was expecting Jerome Powell, and the Fed came out and said, we're only looking to cut twice in 2025. The markets did their thing and actually went along and started pricing in fewer than 2 cuts next year. And now with the Fed funds and the 10-year yield where they are, this means mortgage rates are likely going to hover around the 7% mark, which is pretty high. We definitely know that the 7% mortgage rate is not accretive to the overall real estate market and is actually a detractor in the residential fixed input component of GDP. And then the key question remains, can the US economy operate with a 7% mortgage? And based on the earnings we got from Lennar just a couple of days ago, as well as some of the housing data we're seeing, some of it's good, some of it's bad. The answer to that question, can the US economy operate with a 7% mortgage? The answer is a resounding no. So in my opinion, based on that, and based on all the data we're seeing right now, I think this is the market mispricing information and reacting very, very crazily. And I actually think the Fed's going to cut more than expected next year because they don't want mortgage rates at 7%. They need residential fixed investment to open up and drive growth into 2025 and beyond, as well as the amount of debt the US government has. And Tom Lee sees this as well. He pretty much came out, released this note, and he said, the markets did their thing after the FOMC. He noted that some of the members incorporated Trump policy risk into their forecast, that being tariffs and deportations. These are risks, and they argue for fewer cuts. However, he sees equities as overreacting to the downside. He sees the RSI as oversold, and this is where he expects a rally to start, and he would strongly advise to buy the dip. So Tom Lee thinks we're going to rally from here. I think we're going to consolidate. However, there are definitely tailwinds for a rally into the end of the year, one of them being the formal Santa rally. Now, for those of you that don't know, the actual Santa rally is the last 5 days of the year and the first 2 days of the new year, 7 trading days in total, and the average return in that time period is 1.36%, median 1.35, 87% or win rate. The only time we didn't see a loss apart from last year was in 2014. You have to go back 10 years where we fell 2.9%. And if you exclude 2014, right, you have to go back all the way to 2007. 2007 was a loss, and it's not even in this data set, all things considered. So Guys, we do have the Santa rally on our side, we do have seasonals on our side, as well as sentiment being very negative. That could bode well for an upside surprise. Tomlin thinks you should buy the dip right now. I think wait for some consolidation, don't deploy all your capital, buy the ETFs you like, but still wait for these single stocks to roll over. However, when you look at stuff like Paycom and PayPal, they're down like 7, 8, 10% from their highs. There's nothing wrong with maybe starting to nibble in those names, maybe stocks that have corrected from their highs. Nonetheless, I do think that you should start looking at opportunities because sentiment can change quickly and sentiment drives price. And guys, we do know that the macro looking very constructive. We got Q3 GDP revised up to 3.1% in 2024. The market kind of brushed this off, but we should see a repricing sooner rather than later. And we just had very robust economic growth, excluding the first quarter of 2024, just very, very solid growth throughout this year and in the last 2 years. Something else that's supportive for equities, the LAI officially rose for the first time since February 2022. You see the slight uptick right there. The LAI rose for the first time in 2022 and it's no more signaling an impending recession. The reason why it rose was actually because of stronger building permits and higher stock prices that boosted the overall LAI, and it's no more signaling a recession. But there are risks to this market, one of them being a government shutdown. Betting markets are saying there's a 65% chance of a government shutdown before the end of this year. That is a risk. We'll see if the CR spending bill gets put through. Hopefully it does and we can just continue without interruption. But if it does, that can bring volatility. Now we are heading into Christmas week next week and we're going to have a light week of earnings and a light week of data. But there is some stuff. We have durable goods orders on Tuesday as well as new home sales. That's on Tuesday. Then on Thursday, we have initial jobless claims. And then on Friday, we just got the goods trade balance, retail inventories, and that's really it. We don't really have much in terms of data. And then for earnings, we only have a couple of stocks reporting, none of them that I actually know. I think they're all small caps. Yeah, they're all under, these are probably micro caps. They're all under $1 billion. So nothing notable from the earnings side. So it's probably going to be a very light week of trading, low volume. However, guys, take this time to rest up, shore up your watch lists, and take advantage of any dips you do see in the stocks, ETFs, and assets that you like. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.